Hello everybody, I'm Jay Diamond, Managing Partner and Chief Market Strategist, as well as an advisor here at Investmark. And this is our fourth quarter 2015, or actually first quarter 2016, however you want to look at it. But this is our year-end summary on the economy and the markets for last year and a look ahead to 2016. We tend to do these things every quarter, and the reason why we do them is we try to answer the question or shed light on what's going on with the economy, the markets, taxes, interest rates, inflation, unemployment, government debt and spending, a whole host of things that you might hear and read about. And we do this so it gives us a little bit of insight as to how these areas might unfold in the future and interpret what's going on currently. Of course, looking ahead, nothing is ever certain. And we like to share with you the type of things we're studying and staying abreast of to better help you with your wealth management and financial planning and your investments, of course. So with that being said, let's get into it. We like to always start off with this executive summary, and this kind of gives you kind of the highlights of what we want to talk to you about today. And today, by the way, is January 8th, 2016. That's important because things unfold on a day-to-day basis, and that might shape things a little bit. So consider that when listening to this. So let's look back at 2015. And before we even look at some specific numbers, I think it's safe to say that 2015 was not a good year for the markets. And I think most people know that already. Matter of fact, to spin it a little bit more, it was actually the worst year since the crisis of 2008. But as we'll talk about, it really wasn't as bad as you might think. And also, interestingly, we will point out that there was a bit of a disconnect last year between the U.S. economy, which didn't do that badly, and the markets, which, again, as we talked about and we'll talk about, had a bit of an off year. So let's examine some of the numbers here to put everything in perspective. First of all, we always talk about the U.S. market in terms of the large cap stocks, the S&P 500, which is the 500 largest stocks. We tend to use this instead of the Dow because it's a better overall representation. So you'll hear that throughout today's discussion. So last year, if you just look at that in a vacuum, that category was up a little, 1.4%. Now, within the broad market, there are exceptions and variations around that mean. And the best sector of the stock market was consumer discretionary items. People did shop, and overall that category was actually up 10%, those stocks. On the other hand, the worst sector, and I think most people have a sense of this anyway, was the energy sector, and we will talk quite a bit more about that, being down 21%, which is quite notable. Other sectors of the market that are very important is the small cap side, and those are represented by the Russell 2000, and that was down about 4.5%. International stocks, an important part of all portfolios, everything outside of the U.S., that's really what we're talking about. Collectively, we're down 5%. Now, if you focus on just more the developed side of the international markets, Europe, Australia, Far East, essentially Japan, that was down about 0.5%, so not that bad. But, embedded in that -5 is the emerging markets, which had been darlings in certain prior years, but last year, as we'll talk about, were down substantially, down 15%. Shifting our overview a little bit to bonds, overall bonds were flat, maybe up 0.5%. But within that, there was some divergence again, and municipal tax-free bonds were actually up about 3.5%, and high-yield bonds were down 4.5%. The other noteworthy sector that, besides oil, as we'll talk about, and energy, the broader commodities overall were down about 25%. So that is quite notable, and it was driven mostly by oil. And of course, money in the bank or cash or money markets, retrospectively, would have earned you somewhere in the neighborhood of zero. Maybe 0.1, maybe 0.2, but essentially flat. No surprise there. That we could have predicted ahead of time. And we'll pretty much predict the same thing going forward for 2016. Another thing that we talked to you about, and I think we've gotten people educated about, is there's different investment styles, such as growth stocks and value stocks. And it was also interesting to see some divergence here. Even within large company stocks, the growth type companies, a lot of technology companies and such, beat the value companies substantially. Large cap growth up 5.7 and large value actually down 3.8. So that's quite a bit of a difference there. Not altogether unusual, but more difference than we might normally see. Now, moving down from large cap stocks, it was a year when large cap stocks actually beat mid cap stocks and beat small cap stocks. But across the board, all mid cap styles and small were actually negative. And when we get into the closer look section, which I encourage you to listen to as well, we'll display that so that you can see it. So some other topics here that, what is the market, looking at, what went on last year? Well, here are the big topics. The Fed finally did tighten, raise interest rates, 0.25%, not unexpected. It didn't happen until December 2015, and it was expected that might have happened earlier in the year, and there might be more than one. But now that 2015 is in the books, we see that the Fed, in fact, started the process of raising rates, 0.25%. The question is, are there more to come? Probably. We'll talk about that more. Another big story, especially in the last week, but even for 2015, was China, and really other emerging markets as well. And their economies went through a bit of a slowdown, and their markets reflected that even more so, and we'll talk about that. I alluded to the weak energy sector, obviously a very big story with the price of oil getting slashed substantially and what the ramifications of that are. And the dollar versus other currencies was strong last year. It appreciated. We'll talk a little bit more about that. And so that was a factor that had both positive and negative impact. I don't think we'll ever go a year or a quarter without highlighting some of the geopolitical events or risks. And so, for example, just to name a few, Russia with Syria, Middle East refugees streaming into Europe, continued ISIS and terrorism, Iraq and Saudi Arabia, and of course the latest, just from a couple of days ago, North Korea, and what are they up to or not up to. So there was some resultant market nervousness that is obvious and expected, and a bit of a mood change in 2015 in terms of expectations and outlook, and obviously we saw a lot of volatility, which we will talk about in more detail. So in terms of that Fed, let's just go back to that a minute and just kind of put a spotlight on that, because this is what you're going to also hear in 2016. They raised a 0.25 point in December. Based on, why did they do it? Well, based on slowly improving the economy, because the economy is slowly improving. We'll talk about GDP in a minute. But they're looking at jobs, they're looking at retail sales, they're looking at a lot of other things, but based on what they perceive to be a slowly improving economy, they stepped up and had the first rate hike that we've seen actually in 10 years. Now, we do believe that we will probably see a few more rate hikes in 2016. These rate hikes can be 0.25 point, as the last one was, or they can be a little bit more than that at each time the Fed decides to do that. But we'll go with 0.25 point, maybe a couple of more rate hikes. But this is very data dependent, and as the data changes, the Fed can change their mind on what they think they're going to do. In terms of the 10-year Treasury bond, basically a proxy for interest rates, that currently is about 2.2%, and we will continue to refer to that. But over the course of next year, we would expect that will bounce between 2 and 3%. So probably a trend toward the upside, but probably not radically so. GDP. We need to talk about things in the context of our economy and the economic growth that we have. I had mentioned that the economy is slowly improving. This is a quick look back at the quarterly GDP read. And you can see it bounces around a little. We started the year at a kind of a tepid pace, 0.6%. And then the second quarter looked pretty robust, 3.9. Third quarter, a little more average. Fourth quarter, we don't know yet. Anticipating maybe 2 to 2.5. And when we add it all together and divide by 4, it looks like we might end up with 2 to 2.5% growth in the economy for 2015. Footnote, 2014 was a pretty similar. Outlook for next year, we're going to go with the same number. We think this pace will probably continue at least for the next 4 quarters. But obviously we'll keep an eye on that as well. So let's dig a little bit more into China, since it's probably, if not the number 1 or the number 2 topic du jour. And so I just want to remind you, China is the second largest economy. So in many respects, it does matter. Maybe it doesn't matter quite as much as the markets might think, or our market might think. But it has been one of the fastest growing economies, 7% plus for the last few years. And the nature of that economy is it's an industrial economy primarily, or has been. A lot of infrastructure build out, a big real estate boom. It's something you would expect with a country that is evolving. Maybe they're 40 years behind us in certain respects. But their economy has slowed considerably over the last year. And again, this is because they're transitioning really from an industrial economy as described to more of a consumption, services, technology economy. Think of our economy. And we'll put a little more light on that as well. But this transition does not happen in a year. It does not happen in 2 years. It may not happen in 5 years. It will happen, but it's going to take time, and it will be bumpy. And I think we've started to see some of those bumps recently over the last year in regard to China. And this growth rate, this marvelous growth rate of 7%, which actually used to be 10, might come in somewhere around 5, which still looks a lot better than our growth rate. But if you step back, the long-term outlook for China, in our opinion, really is more positive than negative. You just got to look at the magnitude of the population, and there's still 600 million people that are still living in poor rural areas, and they will migrate and move to the cities, and they will be more like our economy, odds are. So the Chinese stock market, not that we talk about this a lot, but since it's been in the news, in 2015, it actually started going way, way up, and then it went way, way down. And when the smoke cleared, it ended down maybe about 7% below where it began. Now, this year so far, in the first trading week, it's gotten decimated or creamed, and there's been kind of stops put into the market due to the volatility. This needs to sort itself out a little bit. Now, China can also impact and affect other emerging market economies, because many of the emerging market economies, whether they be in Asia or South America, tend to be very commodity based. And as we alluded to, and we'll talk about, commodities got beat up quite a bit, oil and many other commodities, copper, iron, it goes on and on. So these price declines are negative to a lot of the emerging markets since they produce a lot of these commodities. So slowing demand and a strong dollar are all negatives for the emerging market. And we'll talk about what the outlook is there as well. The strong dollar. 2015, the dollar was strong relative to other currencies, the euro, the yen. We've seen that over the last few years. We'll get into more detail in the next section on that. And let's remember, we here in the U.S., we're kind of in a rising interest rate trend now that the Fed has started. On the other hand, Europe and Japan have been lowering the rates. And so that fares well for our currency vis-a-vis theirs. Of course, a strong dollar sounds great, but it does tend to hurt our exports and makes us a little less competitive overseas. Now, weak energy prices This is, we've seen huge swings in oil, mostly to the downside, obviously. But let's remember, this is primarily due to supply and demand. That's really what it comes down to. So the price of oil, and this moves so fast, last I knew it was $35 a barrel, maybe a pinch less than that. But the range that we saw last year, just to remind you, ranged from $60 to about where we are now. So we saw a big drop in the price of oil, which you see at the gas pump, and you smile in that regard, and home heating oil as well. Just to look back, just to remind ourselves, the average price of oil over the course of 2013 and 14 was $90 a barrel. Wasn't that long ago. So what's the outlook for 2016? A little hard to tell, but there's a broad range here I think we're comfortable putting out there, probably between where it is now, maybe a pinch lower, and maybe getting back up to maybe $50, $55 a barrel, but maybe to average overall maybe $40. So still relatively low. Now, we tend to cheer that, but there are sectors of even our economy, as we mentioned, where low energy prices hurt. So the whole energy sector, employment and capital spending, and we'll talk more about that, but those have been impacted to the negative, no question about it. Inflation. So inflation, what they call headline inflation, which is just all inflation from all categories, was again pretty flat, up about 0.5%. Now, core, which strips away food and energy, which jumps around a lot, that came in at a little bit more normal. So, again, what contributed to overall inflation being as modest as it was at 0.4? The fact that energy itself was down, as we just talked about. So you take that out of the equation, headline is low, very low, and core is still fairly low. Corporate earnings, those matter because corporate earnings ultimately drive stock prices, as we'll remind you and prove. But during 2015, corporate earnings generally declined, and we have a chart on that in the next section. For all of 2015, it looks like the earnings on the S&P, the 500 largest stocks taken together, about $120 on that index. The outlook for 2016 is actually to see an improvement in earnings, start to go the other way, which is actually more normal. So we're going to go with 6 to 8% growth on the underlying earnings, which might bring the S&P earnings taken as a group up to about $130 a share. We'll talk about why that's important and how the overall stock market tends to get priced based on that in the next section. So in terms of valuations, again, we talk about this all the time because this determines what should the value of the stock market be, and is it expensive or cheap? Well, currently, if we look at what is called forward earnings, which is what's expected over the next year, and apply a multiple, we come out with a certain level of the S&P or the Dow. We're looking at the S&P, and the current PE, price versus earnings, is a 16-time factor. And as we'll show you, that's not cheap, but it's not expensive either. It's kind of pretty close to an average. So when we put that all together, just to kind of give you something to hang your hat on, but don't necessarily depend on, from where we sit and the things we read and the people we listen to, we think that large cap stocks, the S&P, might be up 6 to 10% this year, which at this point, given last year, you might say, well, great, I'll take it, especially based on the way this market has started out so far this year. But we're comfortable with that. Of course, that's no guarantee. We could have another negative year. It is not likely. It's possible. And we could have returns that are double what we just listed here. You'll have to just stay tuned. Bonds. So one commentary here on bonds, with rising interest rates, most categories of bonds, which are between 0 and 2%, we're kind of projecting that because of the rising interest rates, which tends to be negative, taken with the actual interest that bonds pay, you might end up with a return somewhere of between 0 and 2% on bonds. Now, there's certain categories that might do better or worse. Notably, we feel that high yield bonds which were one of the lower performing bond categories last year, could come in higher than that. They tend to be a little bit more tied to stocks. That's why. Unemployment, they just reiterated this number this morning. The official U3 rate is 5%, which historically is kind of a long-term average, and certainly is a lot better than it used to be. We'll talk more about unemployment as well. Other themes just to keep in mind as we go through 2016. Something from 2015. We generally have a confident consumer. And as we'll remind you, consumption in the U.S. anyway makes up 70% of GDP. And we also see kind of steady and increasing employment. We don't think that 5% unemployment number is going to change radically to the negative, probably might even improve a bit more. Wages are slowly increasing. Low energy prices we think are pretty much here to stay, at least for the next year, relatively low anyway. Housing has generally been strong. We'll prove that out a little later in this. Another theme, the millennials, people born between 82 and 2000, as opposed to Generation Xers or the baby boomers. These are the folks that are really the next generation of consumers, and so they're starting to have an impact on the economy and the markets. So just something to be aware of. Internet of Things is kind of a theme that we've seen bantered about, and that's just the continued expansion of technology and how things are going to be kind of connected to each other much more. There's been a lot of research and development themes going on, especially in the healthcare area, especially in pharmaceuticals. Retail revolution. Retail is not dead. It just is shifting more and more to online sales versus bricks and mortar, but both will probably be here for quite some time. But that is a theme, the shift. Cybersecurity, I think you could probably figure this out. There is going to continue to be more of an emphasis on this. There was something in the latest budget, a big chunk of money dedicated to this for obvious reasons. Dividend growth is a theme that we totally buy into. As the economy does slowly get stronger, there's the potential for higher dividends from companies that do pay dividends. And relatively low interest rates make dividends attractive, and we will quantify that in the next section. There has been a lot of M&A, merger and activity, and activist investing, so that can propel certain stocks or certain industries, takeovers, people trying to kind of get prices of stocks higher when they feel they should be. Innovation is a theme that I think is with us, and that's a good thing. So just some things to kind of be aware of as we kind of move on. I think we've alluded to this, but let's just point it out very clearly. There are risks, which means uncertainties. That's really what risks mean here. There could be economic weakness in Europe and Japan. There has been. They seem to be slowly turning that ship, but it could turn the other way. Continued slowdown in China. That's probably likely as they try to make this shift over time. What's the mood of the markets? That matters in the short term. No question about it. I was a player last year. And the mood of the consumer. If the consumer is confident, then it becomes a self-fulfilling prophecy. If the consumer is not, it can go the other way, at least in terms of economic activity. So lower energy prices, if oil goes to $20 a barrel, you might say goody goody, because maybe you'll pay $1.75 at the pump. But there's ramifications, as we alluded to. It helps create actually instability in the world. Reaction to the Fed moves, this one's a no-brainer. The markets don't like what the Fed's doing. There's a disagreement. They raise the rates too fast. They don't raise rates. Just the reaction to what the Fed actually does this year. And now I don't think we're going to have to sit around and wait. I think we'll actually see some activity there. And of course, the biggest item is and I alluded to this as well, geopolitical risks and terrorism, Russia. You can fill in the blanks here. So we're going to need to see. This is going to be present all the time. I think we just need to get used to it and understand that that's a risk that can spook markets for the right and sometimes for the wrong reasons, at least in the short term. So, we come away from this executive summary section and, kind of make this statement, which we've made in the past, that, due to the uncertainty and all the moving parts, a balanced and highly diversified portfolio is still the best tool for managing your assets. We firmly believe that. That has been proven over time. We'll show you a couple of charts and graphs which at least historically make that case. And we think along with that, at least we believe that having a caring financial planning professional, such as ourselves, to help you formulate and execute a life plan is the best way to pursue your goals. So, that's what we're all about on your behalf. That pretty much concludes kind of the high view, the executive summary section. I would strongly encourage you to kind of click on the next section where we'll try to prove some of the things that we just stated, put a little meat behind the bones, and educate you a little bit further, give you a little better insight as to how things might unfold, and some important investment reminders that I think everybody needs to pay attention to. So please tune into the next section right now.